Hello and welcome to another Investor Daily Product Spotlight. I'm your host, Olivia Grace Curran, Senior Wealth Journalist at Investor Daily. With me today is Sid Kumar, Head of Acquisition Finance at Challenger Investment Management. Thanks for joining us today, Sid.
It's a pleasure to be here. Thanks for having me.
Today we're going to dive into relative return. So Sid, can you please define and contextualize relative return for us in the private credit markets?
Yeah, sure. I'll give it a crack. Look, very simply put, the relative return in our private credit market is the return in excess of something else. And in our world, that something else is the return you would get in the public credit market. So if I'm able to originate a private credit opportunity and I'm able to price that at a spread of, let's say, 500 basis points over the base rate, and a liquid equivalent opportunity is yielding, say, 300 basis points over the base rate, that 2% excess or illiquidity premium is what we call relative return. So it's really the compensation that you're awarded in the private credit market for taking on illiquidity risk compared to the public credit market. Just keep in mind the risk needs to be comparable. So when you've got a double B private credit opportunity, it's got to be compared to a double B liquid bond index. And if you've got a single B opportunity, it's got to be compared to a single B liquid bond index.
So Challenger has a long history in private credit. When have you been able to extract the best relative return in private markets?
Yeah, we've been doing this a long time. Challenger started investing in private credit in 2005. And in the last 10 years alone, we've invested $10 billion in corporate loans. And I've been at Challenger for 9 of the last 10 years. And it's over 190 corporate loans in that period. So there's quite a lot of relative value extracting that we've done, and there's plenty of data points to pick from. But in the traditional sense, the relative value or the illiquidity premiums we get are in line with market for a lot of it. So what we would tell you as our differentiating points or standout points would be things that other managers would tell you. So ability to commit in size, ability to be quick and efficient and deliver for borrowers. You'd say access to relationships with private equity and non-private equity borrowers. So those things are relatively run-of-the-mill. But in my experience, the alpha, or where we get outsized illiquidity premium, outsized relative value, are deals where you have to take an uncomfortable view. Usually that view has to be is one that needs a lot of work to get comfortable with or get your head around, or you've got to do something in a very short span of time, put things through your risk management process, which needs to be robust. And if you can do that and do the right level of due diligence and get advisor input into some of this, you're then able to get an approval for a solution that you can offer to a borrower who will be happy to pay a premium over a liquid market or even a standard private credit loan. And that's where managers typically get alpha. So this would be 1 in 10 situations, because these would not be easy to take an uncomfortable view on. But when you see the right one, you've got to really roll up your sleeves, do the work, put in the hours, and seize the opportunity. And that's usually where the relative value or the illiquidity premium is the most attractive, in my view.
And if you could, Sid, would you be able to take us into those investments where you have achieved outsized premium?
I can talk to some transactions that have matured, that are less information sensitive and on an anonymous basis. So there's been one transaction maybe 4 years ago where the borrower was in a difficult or challenged industry. They needed $70 million to complete on a strategic transaction, and the money was required in 5 days. There was really no way we would be able to do diligence and extend credit to this borrower in a 5-day period. But we did see that the borrower had bonding lines or performance bonds from commercial banks. So what we said to the borrower was, if you could flip some of that performance bonds or bonding lines from that format and provide us with a bank guarantee, which would be payable on demand and on call. And it's under an enforceable New South Wales or Victorian law, Australian law, basically. And we got a legal opinion from lawyers that said to us it was enforceable. Then we could do this transaction for you in 5 days. The borrower saw that, went to the bank. The bank was rated AA minus, and we made it happen literally in 5 days. So we got a bank to give us a bank guarantee. We didn't have to worry about the credit profile of the borrower, as long as the guarantee was enforceable. So we managed to price the deal at close to 8%, which was 4% over the base rate for what was basically AA minus rated risk, because we were taking risk on the bank that was rated AA minus, and we were getting an 8% return for it. And we were only able to do that because we were able to move and do this in a 5-day period. So that's an example of outsized illiquidity premium because of speed. And this isn't a lot of risk we were taking. It was something that was ultimately AA. Another example that comes to mind is, again, a borrower in a difficult spot where they had one large contract with a key client that was running at significantly negative EBITDA that was dragging the performance of the group. They said to us it was because of a dispute that they were in with that client. Outside of that, the business was pretty solid. There was no guarantee from a bank this time, but we were able to, within a 4-week period, do enough due diligence on the legal issues, ensure that the dispute was well and truly past the business, that there wasn't going to be go forward remediation claims or anything of that nature. And once we were okay with that, we got a legal opinion or a legal due diligence report telling us that that was locked away. And we were able to look past it and look at the borrower on a go forward basis. And we were able to provide them credit at close to 9% over the base rate, so close to 13%, for what was a reasonably high yielding piece of paper. And the reason we were able to do this was we were able to look at it and really get our heads around the go forward visibility of the borrower, as opposed to, if you took their audited accounts, it would say a negative EBITDA and nobody would touch it. But if you did the work, rolled up your sleeves and actually picked apart the issues and satisfied yourself with the due diligence, then you were able to get a 13% piece of paper. We put a non-call and a make-whole in there, so we were assured that the debt would be on foot for a meaningful period of time and we wouldn't be repaid. So 2 years later, that borrower turned net debt negative, which almost never happens in the sub-investment grade world. So that's where the cash balance of the borrower is more than the gross debt outstanding. They paid our debt back with a decent make-whole, and we got a fantastic return for our clients. So these are a couple of examples where we've been able to extract outsized illiquidity premiums for either being quick and efficient or being willing to put in the work and take an uncomfortable view on something that might otherwise be a quick no or easy to walk away from.
And Sid, how do you extract market value when spreads are wide or there's market dislocation?
Yeah, good question. It's kind of opposite to today's markets where spreads are super tight. So the unfortunate reality is, when spreads are wide in the market, private credit borrowers often stay quiet. Not many of them want to price their deals, and they want to wait for market conditions to stabilize and for pricing to return to normal. We saw that, for example, during Liberation Day in April 2025, and there was not one deal that was pricing in that entire month until things got back to normal. So what we typically do in those times is we pivot to public markets where spreads may be wider and we can buy things at below par. We pivot to parts of the private credit world that are more liquid. So some of the more liquid term loans in the Aussie market. It's not always easy to get. Typically, you'd need to find a seller that's got an internal reason to sell. So either because of market spreads widening, they're hitting up against an internal risk limit, or someone's tapped them on the shoulder from head office in the US or London to say to them, hey, show me that there's 20 million of this that's liquid. And then if that seller is willing to transact, it's often at a discount to par. So in those market conditions, public markets and secondary activity in private markets tends to be the focus for us rather than primary, because things are typically quiet in primary.
And Sid, you said that's the opposite to current market conditions. So what is your approach to relative value in today's conditions?
Yeah, it is currently tight spreads in public markets. So if you look at single Bs, they're in the 400 spread area, and double Bs are in the 300 to 325 spread area. So those are, quite tight when you look at a 5-year horizon. So what we tend to do, and that those market conditions actually favor private credit because you're still able to get 100 bips or more premiums over those levels. What we tend to do in these market conditions is hold the line or at least stay disciplined on private illiquidity premium. So you'd want that 100 bips premium over liquid markets, and you don't want to go too far below that. If you look at the last 10 years of illiquidity premiums, it's ranged from 100 bips to even 250 bips, with outliers outside that as well. So you don't want to hold, you don't want to reconcile to less than 100 bips. So we try to hold the line there. The other thing we do is, of course, always be prepared. So there's always room for that opportunity where you've got to take an uncomfortable view, or there's a timeline or a deadline, which, we're sitting in mid-November in the lead up to Christmas. There often is something that is a time-sensitive situation, and we're ready for those where you can get an outsized illiquidity premium. So those are some of the ways in which we deal with current market conditions.
Well, thanks for joining us today, Sid Kumar from Challenger Investment Management.
Thanks so much for having me. It's a pleasure.
That's all we have time for on Investor Daily's Product Spotlight. We'll see you next time.